Ever stared at a tax form that felt less like a document and more like, I don't know, an ancient, forgotten language?
Oh, absolutely.
Especially when it comes to decoding your investments. You are absolutely not alone. It can feel like deciphering hieroglyphs sometimes.
It really can.
But what if we told you that truly understanding just one of those forms could unlock some serious insights into your investment income and maybe even pave the way for some remarkably smart tax-saving strategies?
That's the goal.
Today, we're doing a deep dive into Form 1099 DIV, the Dividends and Distributions form. Now, the name might sound a little, well, dry at first glance, maybe.
Just a bit.
But trust us, getting to grips with this form is a powerful shortcut to being genuinely well-informed about where your investment money is coming from, how it's categorized, and, most importantly, how it's being taxed.
Exactly.
We're going to make sure you know exactly where those real savings opportunities are hiding.
That's right. Our mission today is really to extract the most important nuggets of knowledge and insight directly from the IRS instructions for Form 1099 DIV.
Okay.
We're going to help you understand what each item on this form means and, crucially, how to use that knowledge to your advantage.
Right.
Our ultimate goal is to empower you to maximize your tax efficiency. We're going to unpack this form box by box, revealing exactly where the biggest tax implications and, the potential for real savings lie for you, the investor.
Okay, let's unpack this Form 1099 DIV right from the start then. What exactly is it? Why does it seem to land in our mailboxes like clockwork every year? Who's sending this stuff to us? And I guess, why does the IRS care so much about these specific numbers?
Well, fundamentally, Form 1099 DIV is an informational return. Think of it like a report card
Okay.
from your financial institutions to the IRS, with a copy for you, of course. It's filed by what the IRS calls payers.
Right.
These are entities like banks, brokerage firms, mutual funds, other financial institutions.
Gotcha. The place is holding my money.
Precisely. They send this form to the IRS and a copy to you, the recipient, for anyone they've paid dividends and other distributions to during the year. Its core purpose is really transparency and compliance.
Right.
It ensures the IRS is fully aware of your investment income. This helps prevent, discrepancies when you file your tax return and ensures accurate reporting across the board.
Makes sense.
And there are specific thresholds that trigger the filing of this form. So it's not just for, massive portfolios.
Oh, really? What are they?
Generally, a payer must file Form 1099 DIV if they've paid you $10 or more in money or other property.
Just $10. Wow.
Yep, just $10. So, even a small mutual fund holding or a few shares of a dividend-paying stock can easily trigger this.
Okay.
And here's a crucial detail. Even if it's less than $10, if any federal income tax was withheld from your distributions, which we'll definitely talk about later, they're still required to send it.
Yep.
And for those less common situations, if you receive $600 or more in money or other property as part of a liquidation, that also triggers a reporting requirement on this form. It's truly the IRS's way of making sure basically all your investment income is accounted for, once it hits those minimums, leaves very little to chance.
So it's not just about the big bucks then. Even surprisingly small dividend payments trigger this reporting, which probably means most investors will see this form at some point.
Almost certainly, yes.
And I've noticed there are different copies of the form, like a red one and a black one. Can you walk us through what those different copies mean? And why is that distinction so incredibly important, especially for the folks actually sending them out? Because I hear there can be some serious repercussions if you get it wrong.
Oh, absolutely. It's a critical distinction, and you're right. Getting it wrong can lead to penalties, big ones.
Okay.
When you look at Form 1099 DIV, you'll see various copies. Copy A, which is usually printed in that distinctive red ink.
Right. Seen that one.
That's specifically for the IRS. This version is designed to be scannable by their processing equipment. And here's the crucial point that many people, especially those just starting to issue these forms, often miss. You cannot just download Copy A from the IRS website and print it out to send to them.
Oh, really? Why not?
Because those online versions aren't formatted for machine scanning. And if a payer files a non-scannable Copy A with the IRS, well, they could face significant penalties.
Ouch.
Yeah, these penalties can add up fast. They're designed to strongly encourage proper filing and efficient processing by the IRS. It's a very serious warning, basically, to ensure they can handle the millions of these returns efficiently.
Okay, so Copy A is the IRS's special scannable one. What about the others?
Right. On the other end, copies B, 1, and 2 are typically in black ink, and these can be printed from a standard printer. Copy B is for you, the recipient, Keep it for your records. Use it when you prepare your federal tax return. Copy 1 is usually for your state tax department, if your state requires it. And copy 2 is also for your state income tax return, if your state mandates it for local tax purposes or something similar.
Got it.
These black and white copies can be downloaded and printed from the IRS website because they aren't intended for machine scanning by the IRS, only for your records and state filings.
So if you're a payer, the takeaway is clear. Don't just hit print on that PDF for copy A, right?
Right.
That could lead to a monumental headache and some really unwanted penalties.
Exactly. It's a common yet easily avoidable mistake. And for payers, the IRS is really pushing for electronic filing. Hard.
Makes sense. It's faster.
It is. In fact, if you have 10 or more information returns to file, not just 1099 DIVs, but any combo, you may actually be required to e-file them.
Required? Wow.
Yeah, it's not just a suggestion anymore for larger filers. It's a mandate for efficiency. You can find all the options and detailed instructions for e-filing at irs.gov/return. And even if you have fewer than 10 returns, the IRS strongly encourages you to e-file. It's faster, it's more accurate, it's just more efficient for everyone involved.
But what if you really want paper? For just a few?
But if you truly prefer to file on paper for those smaller numbers, and you're not mandated to e-file, you must order the official scannable copy A forms directly from irs.gov employer forms.
Ah, you have to order them specifically.
Correct. They'll mail them to you, typically free of charge. That ensures compliance and smooth processing. Don't try to print it yourself.
That's a great reminder about getting the right forms, and I've heard the IRS has made some changes to how these forms are updated. Something about continuous use. What does that mean for Form 1099 DIV, and what's the practical implication for us?
Yeah, it's a very practical and somewhat modern change for the IRS. Form 1099 DIV and its accompanying instructions are now designated as continuous use.
Oh.
This just means they're not revised annually with a brand new date every single year, like, many other forms. Instead, they're updated only as needed, whenever there are changes in tax law or reporting requirements.
So less paper, maybe?
No, exactly. It streamlines the process for both the IRS and taxpayers, reduces the need to print entirely new batches of forms every year. However, it comes with an important caveat for you, the recipient and taxpayer.
Uh-oh. What's that?
You can't just assume the form or instructions you used last year are identical, even if the revision date printed on the form itself hasn't changed.
Ah, okay. Good point.
You should always check irs.gov Form 1079 DIV for the latest version and any updates to the instructions before you file. It's really the only way to ensure you're working with the most current guidance and avoid potential missteps.
Always check the source. Got it. All right, let's get into the meat of it, the specific boxes on the 1099 DIV. Sometimes these tax forms feel like a game of where's Waldo for your money. Each one tells a story about a different type of income, and as you mentioned, some of these stories have genuinely happy tax endings. They offer significant savings, right?
They certainly can.
Understanding these distinctions is truly where the tax-saving strategies come alive. Let's start with the basics at the top. Your recipient's TIN and account number. Seems straightforward.
It does, but there are a couple of points. Starting at the top, for your protection and security, your taxpayer identification number, or TIN, that could be your Social Security number, ITN, or EIN for businesses, might appear truncated on the copy you receive.
Right, like only the last 4 digits shown.
Exactly. That's a common security measure to protect your sensitive information. However, rest assured, the issuer has reported your complete TIN to the IRS for their records.
Okay, good to know. And the account number?
The account number is particularly crucial if you have multiple accounts with the same payer, or if Box 11, the FAQ filing requirement box, is checked. We'll get to that later.
Okay.
It just helps both you and the IRS correctly link the reported income to the specific account. Can be invaluable if you need to reconcile discrepancies or provide more info later.
Got it. Now, for the big one, the core of most dividend income. Box 1A, total ordinary dividends. What exactly falls into this category, and what's the immediate insight we should grasp here?
Right. Box 1A is often the largest figure on the form. It represents all taxable ordinary dividends you received. Think of it as the grab bag or the primary bucket of investment income.
The starting point.
Exactly. This is your starting point for dividend income that is generally taxed at your ordinary income tax rates, which, could be as high as 37% for top earners.
Oof.
And what's crucial to understand is that this box includes a variety of payments you might not immediately think of as dividends. For example, it includes dividends from money market funds.
Ah, those often feel like interest.
They do, but they're categorized as dividends for tax purposes here.
Whoa.
It also reports net short-term capital gains from mutual funds. But here's the critical insight and a common pitfall. If you've opted to reinvest your dividends back into more shares, a very common strategy for long-term growth.
Which many people do.
Right. Those reinvested dividends are still included here because they are considered taxable income at the time of reinvestment, even if you didn't receive cash in hand.
That's huge. So you owe tax even if you didn't see the cash.
Correct. Many people miss that. Similarly, it includes Section 404(k) dividends, which come from employee stock ownership plans, or ESOPs, paid directly to you.
Okay.
This entire amount from Box 1A will typically go on the ordinary dividends line of your Form 1040 or 1040 SR. And if your total dividend and interest income combined exceeds $1,500, you'll need to report it on Schedule B as well, giving more detail to the IRS.
That makes sense. It's the umbrella term for most dividend income, and that reinvestment point is a huge one. Many probably overlook that. But then we see box 1B, qualified dividends. Yeah, this box, this is where the magic happens for your wallet, isn't it?
Huh. You could say that.
This is truly where the tax savings begin to shine, potentially cutting your tax bill on this income significantly.
Absolutely. Box 1B is the superstar when it comes to tax efficiency for dividend income. And importantly, this isn't an additional amount. It's the portion of the total ordinary dividends in Box 1A.
It's a subset.
Exactly. It's the portion that may be taxed at lower, more favorable long-term capital gains rates rather than your higher ordinary income tax rates.
And those rates can be much lower, right? Like 0%, 15%, 20%.
Correct. Depending on your overall taxable income, this can lead to significant tax savings, especially for higher income individuals, where the top long-term capital gains rate is 20%, much lower than the top ordinary income rate of 37%.
Okay, but there's a catch, right? Conditions.
Always conditions with the IRS.
Yeah.
Yes, there are crucial conditions to qualify for these reduced rates, and this is where strategic planning and understanding the rules really come into play. There are strict holding period rules.
Holding periods. Tell me more.
Okay, so for common stock, you must have held the stock for more than 60 days during the 121-day period that began 60 days before the ex-dividend date.
Whoa, okay, unpack that. 60 days within a 121-day window, starting 60 days before the ex-dividend date.
Exactly. Think of it as needing to own the stock for a good chunk of time, roughly 2 months, around the time the dividend eligibility is determined, which is the ex-dividend date.
So it's not just owning it on the payment date.
Definitely not. If the ex-dividend date was, say, October 15th, you'd need to have held the stock for over 60 days within the period from August 16th to December 14th. The IRS wants to see you're genuinely invested, not just jumping in and out for the dividend.
Okay, that makes sense. They want real investors. And I see something about risk of loss diminished. What does that mean for these holding periods? Is it like the IRS doesn't want us gaming the system?
Exactly. You've hit on the core intent. The risk of loss diminished rule is a critical nuance. It's designed to prevent tax avoidance.
How so?
Well, days where your risk of loss was diminished. For example, if you entered into certain hedging transactions like buying a put option on the stock you own or selling certain call options or entering into short sales of substantially identical property, those days do not count towards meeting the holding period requirements.
So if you protect yourself too much, it doesn't count.
Pretty much. The IRS wants to ensure you're truly exposed to the market risk of the investment to qualify for the preferential tax treatment. It prevents people from just buying stock right before a dividend, hedging it completely to remove risk, grabbing the dividend, and then selling immediately after.
Got it. Clever. Are there types of dividends that never qualify, even if you meet the holding period?
Yes, definitely. It's important to know what's not considered qualified dividends, even if they appear in Box 1A. For instance, dividends received from short sales, payments in lieu of dividends.
What's that?
Payments in lieu of dividends happen when, say, your broker lends out your shares for a short sale and the borrower pays the dividend equivalent back to you. That's not a qualified dividend. Also, certain dividends from RICs or REITs that don't pass through qualified dividends from their underlying investments, and those deductible dividends on employer securities, the Section 404(k) ones we mentioned, are generally excluded from Box 1B.
Okay, so those stay taxed at ordinary rates.
Correct. They'll be taxed at your higher ordinary income rates.
What about foreign corporations? Can their dividends qualify for these lower rates, or is that strictly a U.S. company benefit?
No. They can qualify too, but with very specific criteria. A foreign corporation's dividends are considered qualified if it's incorporated in a U.S. possession, like Puerto Rico,
Okay.
or if it's eligible for benefits under a comprehensive U.S. income tax treaty that the Treasury Department deems satisfactory, and that includes an exchange of information program.
Hmm.
There's a list on the IRS website. If neither of those applies, a foreign corporation's dividends can still be qualified if its stock is readily tradable on an established U.S. securities market, like the NYSE or NASDAQ. Though there are additional requirements for this as well, outlined in specific IRS notices.
So trading on a U.S. exchange helps. Are there exclusions for foreign ones, too?
Yes. A foreign corporation isn't qualified if it's classified as a passive foreign investment company, a PFIC.
PFIC.
Yeah, basically companies generating most income from passive investments, not active business. If it was a PFIC in the dividend year or the prior year, no qualified dividends. Also excluded are dividends from certain foreign corporations involved in corporate inversions after late 2017, unless they're treated as domestic corporations under specific rules.
Wow, okay.
Complex.
It can be. But the so what for you here is immense. Understanding these holding periods, the risk of loss diminished rule, the qualified foreign corporation criteria, it's absolutely vital for tax efficiency.
So knowing the rules lets you plan. Exactly. By structuring your investments to meet these conditions, meaning focusing on genuine longer-term investment in qualifying companies, you can significantly lower your tax bill on dividend income. You move from your potentially high ordinary rate to the lower capital gains rates, which leaves more money in your pocket. Precisely. This knowledge can genuinely encourage a more long-term investment strategy, directly impacting your after-tax returns.
That's a huge strategic insight. Holding long-term often pays off in more ways than one, especially with taxes. Okay, let's move on to the capital gain distributions in boxes 2A through 2F. This seems like a whole spectrum of different tax rates and categories.
You're absolutely right. It is a spectrum, and each part tells a distinct tax story. Box 2A, Total Capital Gain Distributions, shows all long-term capital gain distributions you received from a regulated investment company, or RC.
Like mutual fund or ETF.
Exactly. Or a real estate investment trust, a REIT. It's important to understand that REITs and REITs are generally pass-through entities for tax purposes, meaning they pass through the gains they realize from their underlying investments directly to you, the investor, keeping their character. So if the fund sells stock it held long-term at a gain, that gain passes through to you as a long-term capital gain distribution.
Even if I just bought the fund recently.
Yes, even then. These gains in Box 2A are generally treated as long-term capital gains, subject to those same preferential rates as qualified dividends 0%, 15%, or 20%.
And where does this go on the tax return?
This amount typically goes on Schedule D, which is where you report capital gains and losses from all your investments. However, there's a simplification. If this is your only capital gain distribution for the year and you have no other capital transactions to report, you might be able to report it directly on your Form 1040 or 1040 SR without needing Schedule D.
Oh, that's handy for simpler situations.
It is. Now, the sub-boxes within Box 2A break these capital gains down further because, as you noted, different types of gains can be taxed at different maximum rates.
Ah, okay, like box 2B, unrecaptured Section 1250 gain. What's that?
Right. This gain comes specifically from the sale of certain depreciable real property held by the IRS or REIT. It's separated because it's typically taxed at a maximum rate of 25%.
Higher than the usual 0.1520%.
Yes, higher than the standard long-term rates, but still usually lower than ordinary income rates. This applies when depreciation previously deducted on real property is recaptured as a gain upon sale. Properly identifying this ensures you calculate your tax accurately and don't accidentally apply a lower rate.
Okay, so real estate depreciation gets its own rate. Then there's box 2C, Section 1202 gain. You hinted earlier that one of these boxes holds a truly incredible tax point, almost like hidden treasure. Is this the one?
This is indeed the one. Box 2C holds a potentially massive tax-saving opportunity. It's something every investor, especially those looking at venture capital or early-stage investments, should be aware of.
Okay, lay it on me. What's Section 1202?
Box 2C reports gain from certain qualified small business stock, often called QSB stock. Under Section 1202 of the tax code, a significant portion, or sometimes all, of the gain from the sale of this stock can be excluded from your taxable income entirely.
Excluded entirely. How much?
The exclusion percentages are quite significant and have changed over time. It's 50% for stock issued after August 10, 1993, and held for more than 5 years. It bumps up to 60% for certain empowerment zone business stock acquired during specific periods.
Okay, 50–60% is already amazing.
It gets better. For QSB stock acquired after February 17, 2009, and before September 28, 2010, the exclusion jumps to 75%.
To 75%.
And here's the ultimate tax break, the real treasure chest. For stock acquired on or after September 28, 2010, and generally before January 1, 2014, that gain could be 100% excluded from your income.
100%. That sounds almost too good to be true for a tax form. No federal tax at all.
Zero federal income tax on that qualifying gain. Imagine that on a significant capital gain. It's a direct incentive from the government to invest in and support small businesses. A powerful tax shield.
Wow. But there must be hoops to jump through, right? How do you claim that?
There are definitely requirements. First, the payer, the RIC or REIT, must provide you with a detailed statement. This isn't usually just on the 1099 DIV itself.
Okay, what's on the statement?
It needs to clearly report the name of the corporation that originally issued the QSB stock, the date the fund sold it, your share of the sales price, your share of the fund's basis in the stock, and crucially, the amount of your Section 1202 gain, along with the applicable exclusion percentage, 50, 75, 100%. Without that detail, it's very tough to claim it.
And what makes stock qualified small business stock in the first place?
Good question. The general requirements are quite specific. It must be original issuance stock from a C corporation. The corporation must have had gross assets of $50 million or less at the time the stock's issued and afterwards. At least 80% of its assets must be used in the active conduct of a qualified trade or business, so not just passive investments. And typically, these stocks aren't publicly traded for most of their existence.
So mostly smaller private C Corp initially.
Generally, yes. So if you see an amount in Box 2C, definitely hunt down that supporting statement and probably consult the IRS instructions or tax pro to confirm eligibility and properly claim this incredible tax benefit. Don't leave that free money on the table.
Absolutely not. Okay, moving on. Mock Second reports collectibles, 28%. Gain, what falls under collectibles?
This is gain from sales or exchanges of things like art, antiques, precious metals like gold or silver bullion, gems, stamps, rare coins, basically. Tangible items held for investment.
And why 28%?
It's separated because this type of gain is taxed at a maximum rate of 28%. That's generally higher than the standard long-term capital gains rates for stocks or bonds, but again, usually lower than top ordinary income rates. It's a policy choice, perhaps reflecting a view that these aren't as economically productive as business investments.
So different asset, different rate. Got it.
Knowing this helps ensure you apply the correct, higher rate to these specific gains, and don't mistakenly lump them in with your regular stock gains.
And boxes 2E and 2F, Section 897 gain, you mentioned these are usually for foreign investors.
That's right. Boxes 2E and 2, Section 897 ordinary dividends and capital gain, primarily apply to foreign persons or entities concerning dispositions of U.S. real property interests, or U.S. RPI, while RICs and REITs might need to fill these out based on their underlying holdings and foreign investors.
It's not usually relevant for a typical U.S. individual investor receiving the 1099 DIV.
Exactly. For most of our listeners who are U.S. individuals, these boxes will likely be empty and can largely be disregarded. So the big takeaway, the so what for you, the individual taxpayer, from all these capital gain boxes, is that different types of capital gains are indeed taxed at different maximum rates.
Right. It's not one size fits all.
Not at all. Understanding these distinctions, 0.1520% for most long-term gains and qualified dividends, 25% for unrecaptured 1250 gain, potentially 0% for Section 1202 gain, 28% for collectibles, it's paramount. It ensures you pay the correct tax amount, and often by correctly categorizing the lowest possible tax on your capital gain distributions.
It really highlights how detailed the tax code is, why these seemingly small box numbers truly matter for your bottom line.
Precisely. It's all about precise categorization for maximum tax efficiency.
We've covered the big income boxes, and it's clear how categorization is king. But there are other crucial details on the 1099 DIV that can significantly impact your tax strategy, especially in avoiding overpayment or claiming valuable offsets. Let's dive into those next.
Absolutely. And one of the most important and often misunderstood boxes here is Box 3, non-dividend distributions. This is a huge one for avoiding overpaying, or maybe more accurately, avoiding immediate taxation.
Okay, non-dividend distributions, what does that mean?
What this box typically represents is a return of capital.
Return of capital, like getting my own money back.
Essentially, yes. Here's the critical tax-saving insight. To the extent of your cost basis in the stock, This distribution is not taxable income.
Okay, hang on. Cost basis, that's what I paid for the stock, right? Plus commissions.
Correct. What you originally paid, including those costs. So think of it like this. If you bought a stock for $100 and you receive a $5 non-dividend distribution reported in box 3,
Huh?
that $5 is considered a return of part of your original investment. Your new cost basis in that stock becomes $95, 100 minus $5. But, and this is key, you don't pay tax on that $5 today.
So it just reduces my investment cost.
Exactly. It's only if the non-dividend distribution exceeds your remaining cost basis in the stock that the excess amount becomes taxable to you as a capital gain.
It's example.
Okay, say your basis was down to $4 per share after previous returns of capital, and you receive another $5 non-dividend distribution. That first $4 would be non-taxable, reducing your basis to zero. The remaining $1 would then be a taxable capital gain.
Ah, okay. So it defers tax until I've gotten my initial investment back, or I sell.
Precisely. This is a crucial point for avoiding immediate taxation on these amounts. Many people mistakenly think all distributions are immediately taxable income, but this box highlights an important exception that can significantly defer your tax liability. You'll want to check out IRS Publication 550, Investment Income and Expenses, for more details on basis tracking.
I can see why that's a common trap, thinking you owe tax when it's just reducing basis. That's a fantastic point about not overpaying. What about Box 4, Federal Income Tax Withheld? That seems straightforward.
It generally is. Box 4 simply shows any amount of federal income tax that was automatically withheld by the payer and sent directly to the IRS on your behalf. This typically happens in specific situations where the IRS mandates backup withholding.
Why would they do that?
Most commonly, it's because you didn't provide your taxpayer identification number, your TIN, to the payer when you opened the account. Or maybe you provided an incorrect TIN.
Okay, simple mistake, maybe.
Or it can occur if you were subject to what's called a second TIN notification from the IRS, meaning there were issues with your TIN from a prior reporting period and they told the payer to start withholding.
Got it. So what do I do with this amount?
If this box has an amount, it means the payer automatically sent that money to the IRS for you. It's like a forced prepayment of your taxes. You include this amount on your income tax return, usually on the payments line, as tax withheld. It directly reduces your total tax liability for the year, dollar for dollar.
So it's basically a credit against what I owe.
Exactly. Make sure you claim it.
Right. Moving on to Box 5, Section 199A, Dividends. This sounds like it could be another significant tax benefit for investors, perhaps tied to that qualified business income or QBI deduction we hear so much about. What's the connection here?
It absolutely is connected, and yes, it's a very exciting one for tax-conscious investors. Box 5 reports qualified REIT dividends paid by a real estate investment trust or certain Section 199A dividends paid by a regulated investment company.
Okay. REITs and some mutual funds.
Right. And the tax-saving potential here is substantial because these amounts may be eligible for the 20% qualified business income, or QBI, deduction under Section 199.
The 20% QBI deduction, that's huge.
It really can be. This deduction was part of the Tax Cuts and Jobs Act, designed to give a tax break to owners of pass-through businesses, and it extends to investors in certain REITs and RUITs that distribute this type of income.
How does it save money?
It directly reduces your taxable income before you calculate your tax. So unlike qualified dividends, which get a lower rate, this actually lowers the amount of income being taxed in the first place, potentially leading to a significant overall tax reduction.
Nice. Are there conditions here too, like holding periods?
Yes, similar to qualified dividends, there's a holding period requirement for the REIT stock to qualify for this deduction. You generally must hold the REIT stock for more than 45 days during a 91-day period that begins 45 days before the ex-dividend date.
Okay, another holding period test.
Right. Again, it's to ensure you're a genuine investor. So the so what for you is clear. If you meet these criteria and the other QBI deduction limitations, which can be complex and involve taxable income thresholds, so definitely check those, you could be looking at a substantial deduction.
So it lowers your taxable income directly.
Yes, making investments that generate this kind of income potentially even more attractive from an after-tax perspective.
That's another great opportunity, especially for real estate investors through REITs. This QBI deduction is a big deal. Now, this brings us to Box 6, Investment Expenses. Can I deduct these? Seems logical.
Logical perhaps, but under current law, generally no. That's a good segue because it highlights a common misconception. Box 6 shows your pro rata share of certain expenses from a non-publicly offered regulated investment company. basically your share of the mutual fund's expenses if it's not one traded on an exchange.
Okay, so it's my share of the fund's costs.
Right. And while this amount is actually included in Box 1A as part of your total ordinary dividends,
It's already in the income number.
yes. But under current tax law, this specific expense amount shown in Box 6 is generally not deductible for individual taxpayers on Schedule A.
Not deductible, why not?
This is due to a provision of the Tax Cuts and Jobs Act that suspended miscellaneous itemized deductions subject to the 2% adjusted gross income, or AGI, floor. Investment expenses like these fell into that category, along with things like unreimbursed employee expenses and tax prep fees.
Ah, the TCJA strikes again, and that suspension is still in effect.
Yes, it's currently in effect from 2018 through 2025. So while it's reported on your 1099 DIV, it won't typically provide a direct deduction on your personal tax return right now. It's just an informational item, basically, telling you part of your Box 1A income was offset by expenses inside the fund.
Good to know what not to expect a deduction for then. Saves some time. But Box 7, foreign tax paid, and Box 8, foreign country or U.S. possession, sound like they do offer a benefit, especially for those with international investments.
They absolutely do, and this is a significant advantage for globally diversified portfolios. Box 7 shows the amount of foreign tax you paid on the dividends and distributions reported on this form, perhaps through a foreign stock directly or a mutual fund holding foreign securities.
Okay.
Box 8 identifies the specific foreign country or U.S. possession where that tax was paid. This is a fantastic tax-saving opportunity because it helps prevent double taxation.
Double taxation, meaning paying tax to both the foreign country and the U.S.
Exactly. Without this provision, you might pay tax to, say, Germany on a German stock dividend, and then again to the U.S. government on that same income. This rule prevents that.
How does it work? How do I claim it?
You can generally claim this foreign tax in one of two ways on your Form 1040 or 1040-SR. You can take it either as an itemized deduction, which reduces your taxable income,
Okay.
or, usually more beneficially, you can take it as a foreign tax credit, which directly reduces your U.S. tax liability, dollar for dollar.
Credit sounds better than deduction.
Almost always, yes.
Yeah.
A credit reduces your tax bill directly. A $100 credit saves you $100 in tax. A $100 deduction only saves you your tax rate times $100. So if you're in the 24% bracket, a $100 deduction only saves you $24.
Big difference.
Huge difference. So if you paid foreign taxes shown in Box 7, make sure you leverage this benefit. You'll often use Form 1116 foreign tax credit to claim it. It's a direct offset, a really valuable tool for international investors.
That's a really important benefit to remember. What about Box 9 and 10, liquidation distributions? That sounds a bit final, maybe uncommon for most investors.
Indeed, it does sound final, and yes, it is less common for the average investor to see these regularly, but it's important to understand what they mean if you do. Boxes 9 and 10 show liquidation distributions. Box 9 reports cash distributions you received as part of a partial or complete liquidation of a company.
Okay.
Box 10 reports non-cash distributions from such a liquidation, like maybe shares of another company, with the fair market value listed as of the date of distribution.
And how are these taxed? Are they like dividends?
No. Importantly, these amounts are not included in your ordinary dividends in Box 1A. They're treated differently. Typically, they're treated first as a return of capital, just like the non-dividend distributions in Box 3.
Ah, so they reduce my cost basis first.
Exactly. You first reduce your cost basis in the stock by the amount received, cash plus fair market value of property. If the distribution exceeds your basis, the excess is generally treated as a capital gain long-term or short-term, depending on how long you held the stock.
What if it's less than my basis?
If the total liquidation distribution is less than your basis, you might recognize a capital loss once the liquidation is complete. This separation ensures these distributions are taxed appropriately under capital gains rules, reflecting their nature as a return of your investment, not ongoing income.
Got it. Return of capital first, then capital gain or loss. And Box 11, FACA, filing requirement. What does that check mark signify? Should we be concerned if we see it?
Okay, FACA. If Box 11 is checked, it just means the payer is reporting on this Form 1099 DIV, partly to satisfy the reporting requirements under FACA. That's the Foreign Account Tax Compliance Act.
Right, FACA, I've heard of that. Designed to catch offshore tax evasion.
Exactly. So this checkmark implies that your financial institution has identified you or your account as having some kind of foreign connection. Maybe you have an address outside the U.S., or you indicated foreign tax residency somewhere along the line.
So what does it mean for me, the recipient?
What's crucial is that if this box is checked, it may mean that you also have a filing requirement for Form 8938, Statement of Specified Foreign Financial Assets.
Form 8938.
Yes. This form requires U.S. taxpayers to report their foreign financial assets to the IRS if the total value exceeds certain thresholds. Those thresholds vary based on your filing status and whether you live in the U.S. or abroad.
So the check mark is a flag, a heads up.
Pretty much. It's not necessarily a cause for immediate concern, but it's a clear signal to review your potential officio obligations. Check if you need to file Form 8938, or maybe even the FBAR, which is FinCEN Form 114, Report of Foreign Bank and Financial Accounts, if you haven't already. It's all about ensuring transparency for the IRS regarding your global assets.
Okay, good flag to be aware of. Now let's talk about boxes 12 and 13. Box 12, exempt interest dividends. Sounds very promising. Exempt is a word we absolutely love on tax forms. Tell us more about this one.
It is indeed a very appealing word for taxpayers, and for good reason. Box 12 reports exempt interest dividends. These usually come from a mutual fund or other RIC that invests in municipal bonds.
Muni bonds, issued by states and cities.
Exactly. Debt securities issued by state and local governments. And a key feature of many municipal bonds is that the interest they pay is generally exempt from federal income tax.
Tax-free income.
Federally tax-free, yes.
Yeah.
This is a significant tax-saving feature, particularly for individuals in higher tax brackets. A mutual fund investing in these bonds passes those tax-exempt dividends through to its shareholders, reported here in Box 12.
So this whole amount is just not taxed by the feds.
Generally, the amount in Box 12 is not subject to regular federal income tax. For someone in, say, the 32% tax bracket, very attractive.
Definitely. But there's usually a but, isn't there? What's box 13? Specified private activity bond interest dividends.
There is indeed a but, and Box 13 is it. This amount is a portion of the total exempt interest dividends reported in Box 12. It represents the part that comes from specified private activity bonds.
Private activity bonds, what are those?
These are still municipal bonds, but they're issued to finance projects that primarily benefit private entities rather than the general public. Think of things like maybe a privately operated airport facility, a sports stadium, certain types of housing projects.
Okay, so they benefit private companies more directly. Why does that matter for taxes?
It matters because the interest from these specific private activity bonds, while still exempt from regular federal income tax, is considered a tax preference item for the alternative minimum tax, or AMT.
Ah, the AMT, the parallel tax system.
Exactly. The AMT is designed to ensure that taxpayers who benefit from certain tax preferences still pay some minimum amount of tax. And interest from specified private activity bonds is one of those preferences.
So the amount in box 13 could trigger AMT.
It could. The so what for you is this. While most exempt interest dividends in Box 12 are truly federally tax-free, understanding Box 13 is crucial to avoid an unexpected AMT liability. If you receive these dividends, they might trigger or increase your AMT if your income is high enough and you have other AMT preference items.
So even tax-exempt isn't always completely tax-exempt if AMT comes into play.
Correct. It's an important nuance. Knowing about Box 13 helps you plan and avoid an unpleasant surprise if you might be subject to AMT.
That's a great example of how a seemingly small detail can have a big impact. Highlights the complexity. Okay, finally, boxes 14 through 16 seem pretty straightforward dealing with state information.
Exactly. Boxes 14 through 16 are generally straightforward and quite useful for filing your state tax return, assuming your state has an income tax.
What do they show?
Box 14 will show the abbreviated name of the state, either where tax was withheld or possibly where the dividends are sourced according to state rules. Box 15 lists the payer's state identification number, their unique ID with that state's tax department. And Box 16 indicates any state income tax that was withheld on your dividends.
So similar to the federal withholding in box 4, but for the state.
Precisely. These boxes are provided for your convenience and are essential for accurately preparing your state income tax return. You'll use this information to report correctly and claim any state tax withheld as a payment against your state tax liability.
And state rules on taxing dividends might differ from federal.
They can, yes. Some states might exempt certain types of dividend income that are taxable federally or vice versa. Some states tax municipal bond interest from other states, even if it's federally exempt. So this state-specific information is key to navigating your state obligations correctly.
Got it. Expert, we've navigated the intricate landscape of the 1099 DIV, breaking down each box, uncovering the tax implications. So what does all of this mean for you, our savvy listener, as you approach your own tax situation? What are the key strategic takeaways here that can genuinely lead to tax savings and smarter investment decisions?
Well, I think the biggest strategic takeaway, and something we emphasize repeatedly, is the real power of understanding and utilizing those holding
For
periods.
qualified dividends and the QBI deduction.
Exactly. Meeting those holding period requirements isn't just some technicality. It's a fundamental strategic decision for your investments. By being mindful of how long you hold certain stocks or REITs around the relevant dates, you can directly influence whether that income is taxed at higher ordinary rates or significantly lower capital gains rates, or even qualifies for that substantial 20% QBI deduction.
So knowledge lets you actively manage the tax outcome.
It really does. And this knowledge encourages, often, a more long-term investment strategy, which usually aligns with good financial planning anyway. You're optimizing your after-tax returns.
Great point. What else?
Secondly, categorization is absolutely king. It becomes incredibly clear from going through each box that not all dividends or distributions are created equal for tax purposes.
Ordinary, qualified, capital gain, return of capital, exempt.
Right. Understanding the precise distinctions between all those categories is fundamental. It's crucial for accurate reporting and, more importantly, for minimizing your tax burden. Getting it wrong could mean you overpay. Knowledge here really translates into direct, tangible savings.
Don't leave money on the table by miscategorizing.
Precisely. And third, don't forget about leveraging exempt income. Those exempt interest dividends in Box 12 offer a significant benefit, being federally tax-free, especially valuable if you're in a higher tax bracket.
Oh, watch out for.
But as we discussed, you must be acutely aware of Box 13 and the potential AMT implications for those specified private activity bonds. Knowing these nuances allows you to plan accordingly, maybe avoiding an unexpected tax bill.
Okay. What else should we remember?
Also, always remember to claim available credits and deductions. That foreign tax credit or deduction from Box 7 is a direct offset against your U.S. tax for foreign taxes paid. Don't just ignore it,
Right. Dollar for dollar savings usually with the credit.
usually. And similarly, any federal income tax withheld shown in Box 4 is a direct credit against what you owe. These aren't minor details. They're direct reductions to your tax bill. Make sure you claim them.
Absolutely. Any final advice?
Yeah, my advice to every listener is keep good records, track your bases, especially if you get those Box 3 non-dividend distributions, and when in doubt, consult the source. The instructions for Form 1099 DIV and other IRS publications like Pub 550 are your primary, continuously updated sources for detailed guidance.
Don't be afraid to look it up.
Definitely not. They're designed to clarify these complexities, and while they can seem dense, they're often surprisingly clear once you know what you're looking for. Oh, and one last practical note, the nominee rule.
Nominee rule.
If this form you receive includes amounts that actually belong to another person, maybe you hold stock in your name for a child or a relative, not your spouse, you're considered a nominee recipient. You then have a responsibility to file your own Form 1099 DIV for them, passing along their share of the income.
Ah, so you have to issue a 1099 too.
Correct. It ensures everyone reports their correct share of income, helps maintain the integrity of the system.
This deep dive really shows how understanding these seemingly small details on just one form can lead to some truly big aha moments and very real, tangible tax advantages. It's not just about, dutifully filling out a form. It's about making informed financial decisions that directly impact your bottom line.
Precisely. And, this raises an important question for you, our listener, to maybe think about. Beyond simply entering numbers into tax software, how might this deeper understanding of these different dividend categories and their diverse tax treatments actually influence your future investment decisions?
Good question.
Will it change how long you hold certain stocks? Or maybe even what types of income-generating assets you choose for your portfolio, now that you know how differently they might be taxed? It's something to consider.
Such a powerful thought to end on. Thinking proactively about taxes when making investment choices, we hope this deep dive has demystified Form 1099 DIV and given you the confidence to approach your tax filing with more clarity and hopefully more strategy.
Hope so.
You can always find more information and the very latest updates. Remember that continuous use point at irs.gov Form 1099 DIV and also in the general instructions for certain information returns. Thank you so much for joining us on this deep dive.
Thanks for listening.
Until next time, keep learning, keep growing, and keep those tax savings in mind.